Hey guys, so a lot of times when you read an article and it says a company, like a corporation, paid little to no taxes at the end of the year or when they filed, and you're like, how does that happen? How are they getting all these tax breaks? Well, number one, the U.S. tax system is made for businesses. It's made for businesses because businesses feed the economy, but that doesn't mean you as an individual can't take advantage of tax breaks as well, which you can. So I wanted to talk about a little bit about tax breaks and a few of the major items that kind of go into it. First off, I'd like to talk about the two different types of tax breaks, or the two main types of tax breaks, which are tax deductions and tax credits. So a lot of you hear about deductions because you'll see a post and they're like, "Here's how you can deduct almost every expense you ever had." For a lot of people, that's not going to be possible, but for many people it is, especially if you own a business and you're earning income multiple ways. But the main thing with tax deductions is to realize that unless you have more, if you can itemize more expenses than the standard deduction that you're eligible for. So the standard deduction is based on your filing status. Unless you can exceed that amount, most of the time it's better to just do the standard deduction. So I'm saying standard deduction, so I'll go into kind of what that is. So your standard deduction is based off of your filing status. So if you've ever filed your taxes, you know you're going to be a few things. You're going to be married filing jointly, you're going to be head of household, you're going to be single, you're going to be a qualifying widower, or you're going to be married filing separately. And based off of which of those filing status you fall under, you'll have a standard deduction. So for married filing jointly, I think it's 24,400. For head of household, it's 18,350. For single, it's 12,200. For widower, it's I think 24,300. And for married filing separately, you get the single standard deduction. So what does that mean? So the thing with the standard deduction is it reduces your taxable income. So let's say your gross income is 24,000, and then you are a single person, so you don't have any qualifying dependents. You're a single person, you've never been married. You're gonna have a standard deduction of 12,200. So that means you won't get taxed based off of that 24,000. You'll get taxed based off of that 24,000 minus your standard deduction, which is 12,200. So you're looking at 11,800 is your new taxable income. I hope I did that right. So the reason why I'm talking about this as a tax break is because based off of your household and based off of actual information and how you organize your finances in your household throughout the year, you can try to get a more favorable filing status. So I'm not talking about just claiming your cousin Pookie. I'm talking about, let's say you're a co-parents, unmarried in a household. Depending on who pays more for what, if one of you have, if y'all have kids and one of you pays more of the bills throughout the year, one of you can qualify for head of household. But let's say y'all paid 50-50. This one person who paid, they didn't pay more than 50%. If they claim both kids, they're still going to be single. They're going to be single with claiming 2 kids for deductions and credits. But if one of you pays more than 50%, you're eligible because you not only do you have qualifying dependents, which are the children, but you're eligible for head of household because you pay more than 50% of your household's expenses, or more than 50% of the expenses for those dependents. So that's the difference for what the filing statuses can do for you. And also if you're married, so there are various reasons why people file married filing separately rather than jointly. But for one thing, for married filing separately, you can take less tax credits, and I'll talk about tax credits later. But for married filing jointly, the standard deduction is 24,400 versus the 12,200 that you'll be getting separately. So that just means that it really depends on what your income is like. But let's say one person makes a whole lot more than the other person, and maybe married filing jointly will be a better option. Or it just depends if they're going to have a higher tax liability that you already know. But most of the time, your tax professional can run a few scenarios with you and your spouse's finances to see what is the best option for you. What else? Yeah, and also for married filing separately, I know a lot of people just think, oh, I just want everything separate, and they don't even run the numbers. But depending on if you have kids and depending on some other financial situations that you have going on, a lot of times you qualify for less tax credits when you file married filing separately rather than jointly. So other than the standard deduction, which we just talked about, there's also another benefit to being a little bit strategic on your filing status, which is all of these filing statuses have different tax rates. So the tax brackets are different. So let's say for the example I gave of the two co-parents with 2 children. So if one of them, so if they're both, if neither one of them pays more than 50% for the household or 50%, more than 50% for their dependents, and neither one of them can file head of household. So they're both filing single. But the benefit of head of household is you can earn more. So let's say you're unmarried, so you only have single or head of household, single or head of household anyway. If you file head of household, the tax bracket, let's say for the tax bracket of 12%, the tax bracket of 12%, you can qualify for it as long as you don't make more than like $40,000. But that tax bracket, that tax rate jumps up to like 22%. If you make more than $40,000. But let's say you are a head of household. That's for if you're single. If you're head of household, you can make up to $50-something thousand and get that 12% tax rate still. So that's something that you can strategize. Yeah, and then so I talked about the standard deductions. So those standard deductions, like I said, reduce your taxable income. If you qualify for, or if you decide to itemize, the idea is that you should keep records and have more expenses that you can itemize that exceed these amounts. Because let's say you're like, oh, I'm going to itemize and I'm going to claim all these deductions, but your total deductions that you're itemizing, because you only have one choice, you have to either take the standard deduction or itemize. If you're itemizing, you're single and your deductions that you counted up counts to like 10,000, then you should still take the standard deduction because you'll be reducing your taxable income more with the standard deduction than just merely trying to deduct $10,000. And so yeah, the other alternative is the itemize. So anyway, everybody should be keeping good records and of expenses that are tax deductible, and just keeping good records of your expenses in general. But if you do that and you have enough expenses that exceed these standard deductions, then you can itemize and even increase that deduction. So let's say rather than as a single person taking a standard deduction of $12,200, you kept up good records and you had actual deductible expenses of $20,000, and now you've reduced your tax liability by $20,000 rather than the $12,200. And if I'm losing you guys, just know that you can always text me to get more information. So yeah, that's tax deductions and that's filing status. But also we could talk about tax credits, which is the other way that you can take tax breaks. And that really depends on a lot of different factors. But tax credits are kind of the bread and butter, I would say, in my personal opinion. Why? Because rather than reducing your taxable income, so tax deductions reduce, I'll do a down arrow, taxable income. The good thing about tax credit is they reduce your actual tax liability or your tax bill. So let's say you took your standard deduction. Let's say you earned $24,000 and you're single. That means that you're in the 12% tax bracket. And let's say you took the standard deduction. So your taxable income was at $11,800 because you took that $12,200 standard deduction and you made $24,000. Your taxable income is $11,800. You've done your deductions because you took the standard. The cool thing about tax credits is, let's say if they gave you a bill, what's 12% is? All right, let's put up an imaginary tax rate of 10% so I can do the math in my head. Let's say your federal tax bill is 10% of that taxable income. So let's say $1,100. $1,100 or something like that. Let's say it's $1,000. What tax credits does is it reduces that tax bill dollar for dollar. So let's say you have you went to school full time last year. You can take advantage of the American Opportunity Tax Credit, which is a $2,500 tax credit that has a refundable portion of 40%. So there's two types of credits. It's either refundable or non-refundable. The benefit of refundable means that if your tax bills drop down to zero, a portion or all of the remainder of that tax credit is refundable to you. So for the American Opportunity Tax Credit, let's say your tax bill is $1,000 and you went to school full time and you're eligible for the American Opportunity Tax Credit for that tax year. That tax credit is $2,500. So your bill, let's say your bill was $1,000. and you had that tax credit that can reduce your bill to up to $2,500. So now, so it's the actual bill. So just now your $1,000 tax bill is $0, and there's still $1,500 left of that. So for the American Opportunity Tax Credit, up to 40% of the total tax credit is refundable. So 40% of $2,500 is $1,000. So that zero tax bill turned to a $1,000 refund. A $1,000 refund to you, because up to 40% of that $2,500 tax credit, once it's brought down to zero, is refundable to you. Yeah, and then there's a few other tax credits, like everybody hears about the earned income tax credit, and then child tax credit. So if you're not a qualifying dependent yourself, and you have qualifying dependents or qualifying relatives, such as parents that you take care of, and you pay more than 50% of their bills, then you can qualify for those tax credits. So yeah, I would say the tax credits is the bread and butter, and that's something that you just have to figure out throughout the year how you can become eligible for tax credits. But yeah, they're the bread and butter because they bring your actual tax bill down to zero. And deductions is smart. If you can itemize a whole bunch more than your standard deduction, then that's a benefit there. But if not, just making sure that you're setting your finances up in your household in a way that you're actually setting it up. Okay, we're not talking about fraud where you're just gonna go try to claim a whole bunch of people and have them say that you paid their bills or something. Talking about actually setting up your finances in a way that you qualify for the best balance that is for you. I know this is very long-winded, but this is the benefit of having a tax professional that can talk through some of this kind of stuff for you and actually strategize, because there's one thing to, go online and be like, oh, okay, you just click through the test and it's not asking you about your household, and you don't have anyone prior to you filing telling you like, all right, here's a few things that you can do for the following year. You don't have anyone planning your tax bill with you if you're doing that on your own. So if you're interested, I am taking clients for this tax year for tax preparation, and also that'll be based off of, your 2019 year, but moving forward with tax planning and making sure that you're eligible for as many credits and deductions as you can, and that we get you the lowest tax bill that we can. So yeah, I hope you guys learned something today. I know it can get long-winded, but I appreciate you listening this far, and I'll talk to you next time.